Hi everyone, this is David Kubik, and thank you for spending a few minutes with me today. This is only the third time in the past 10 years we have reached out specifically to the attractiveness of fixed income. Some of these times have been short-lived dislocations in the market like an election or the recent pandemic. This time may last longer in nature, but it is always difficult to forecast how long this opportunity will last. This message specifically is for investors that have been waiting for an attractive opportunity to create income. If you have excess cash at the bank or funds earmarked for income, I believe this is a great time to be entering the bond market. As you all are already aware of this slide from our recent markets outlook, this is showing the significantly elevated gross inflation and the core inflation rates. What I want to focus on is the Fed's reaction to this level of inflation and therefore on the fixed income markets. We haven't seen this level of inflation in 4 decades, and this is what has caused one of the largest price declines in the history of the bond market, as the Federal Reserve has taken a justified, aggressive stance in raising the federal funds rate to ultimately bring inflation back to a reasonable level. The bond market has reacted very quickly and has already priced in the future rate hikes. To give you a sense of this devaluation of the overall bond market year to date, let's review this next slide. Now, this is almost 50 years of performance of the bond market using the broad U.S. aggregate bond index as the benchmark. The gray bar shows the calendar year return of the AG index, and the red dot shows the drawdown, or the lowest value within that calendar year. As you can see, there are just a handful of negative return years in this period of time. Looking at the far right, the AG is down 15% year to date. This is incredible. Now, this isn't your portfolio, and we have managed well through this year. That being said, prices have been hit incredibly hard, and therefore yields, remember, that move inversely to prices, have spiked to levels we haven't seen in many, many years. These historically have been great times to invest in bonds, not just to lock in attractive yields, but we have typically seen significant appreciation following. Let's take a look at how far rates have moved. This is the Treasury curve. Now, this is not what your portfolios are comprised of, but would like to show you just how far interest rates have moved. Take a look at the lower gray line where interest rates were at the beginning of the year. You can see on the short end, interest rates were near zero as the Fed had brought the federal funds rate down to zero through the COVID pandemic. So the short end of the yield curve, think 2 years and shorter, reflects monetary policy. This part of the curve is adjusting rapidly to where Fed funds is priced and where it's headed. You can see how dramatic the short end has moved. The 2-year Treasury sits today around 4.4%. Now, the longer end of the yield curve, think 10 years and longer, is focused on future inflation and future growth expectations. We also have seen a very dramatic shift in longer dated treasuries and believe this is a strategic time to be lengthening duration and to lock in these attractive yields. Now, yields could always move higher, but we believe most of the movement in fixed income is already priced into the market. Let's take a look at what the market expectations are. The Fed's desire is to raise rates to a level above their long-term goal and a restrictive nature to cool the economy. This chart shows us where the Fed funds rate is today and where it is projected to go. As we forward look out 2 years or so, we can see general consensus of Fed funds reverting back to 2.5%, and that is shown on the purple dot. So interest rates, current interest rates, are significantly elevated as compared to where we believe rates will be in the next couple of years. It is important to understand duration, or the overall interest rate risk that exists within a bond portfolio. We strategically have managed our bond portfolios these past 2 years to lower our overall interest rate risk by keeping the average life or the duration of our bond portfolios significantly shorter than the benchmarks. This illustration shows the potential price increase or decrease of a bond using different year durations given just a 1% shift in interest rates. So if you had owned longer maturity bonds in the early part of this year, there would have been significant devaluation. As we feel that rates are close to peaking, we believe that now is the time to be locking in intermediate to slightly longer duration bonds. On the next slide, I will show some examples. Starting in the upper left corner, we all remember where cash or money market rates have been these past couple of years, almost zero. Well, as of yesterday, the Schwab Value Advantage Money Market Fund is paying 3.7%. So at an absolute minimum, if you are sitting on excess cash at the bank, the market has given us a very attractive rate on cash. On the bottom left corner, we are as a firm very active investors in investment grade corporate bonds. These are a couple examples in the intermediate maturity range with a duration just over 6. 3M Company and Kellogg Corporation, 5.5 yield to 5.7% yield on that. On the bottom right corner, I would like to focus on the municipal bond market. Now, this is where I believe there is a tremendous value. And remember that investors in municipal bonds do not pay federal tax on their income. So this is an example of a municipal bond that we purchased recently. White City Water District, Utah. It's a water and sewer rev and has a duration of just over 7 years with a AA- rating, so a high quality municipal bond. And the yield is a 4.34. The taxable equivalent is 7.33, and that's using the highest tax bracket, but a 4.34 on a high-grade intermediate municipal bond. So again, we are looking at investment-grade corporate bonds with intermediate maturities, the 5.5 to 6% yield range, high-grade municipal bonds in the intermediate range also in that 4.25 yield range. So this is a very exciting time as we have been waiting patiently for an opportunity like this. I wanted to thank you for your time today. Please feel free to reach out to me or any of my colleagues with any questions. Thank you.